We've got a video for you about triple net leases and how leverage versus all cash works. We got an amazing question on our channel in the comments, and we really love when people leave good questions. Our goal here is to produce really great content where you can learn some stuff. And so when we get a question like this, it really excites us. So we went on and we answered it, but we also wanted to create a whole video to really explain in depth. So we're calling this Invest in Wisdom 207, and this is about commercial real estate. I'm David Shapiro with my colleague Lee Abraham at the Shapiro Group here in Austin, Texas. So let's dive in. We'll start with the question. So,
my confusion is how using leverage can make you more cash than when you pay for the property outright. Wouldn't the cost of a mortgage eat into your profits?
Yeah, and it's a good question.
It's a great question.
Let's go through and talk about how all this works. So triple net is the term. If you haven't gone back, watch our triple net video where this question was asked, and it explains what that means. But let's just talk about your potential gross income. And then from there, in real estate terms, you would subtract out vacancy. And I remember when I was doing real estate, this didn't really make sense. Why wouldn't you just take the actual income? I mean, why do you have to put this subtract out this potential vacancy? And it depends if we're looking at a pro forma or we're looking at actual numbers. But in either case, we actually put these numbers in there as vacancy. Effective gross income would be after that. Then you have your operating expenses. And so the ones with the little carrots on the end here, right? So these are negative. So we're subtracting these out. So we're subtracting out operating expenses, which gives us our net operating income, or NOI, which is a really popularly used term in commercial real estate, NOI. And then from there, you subtract out your debt service, and that would be your mortgage payment, and that gives you your cash throw off.
So one of the reasons why sometimes a vacancy, for example, can be used as a placeholder is because savvy investors are going to look at ratio analysis, and there's a vacancy that should be factored into any forecast. If you're looking at an investment property that says, no, don't worry about it, there's never going to be a vacancy, well, you may have an issue. Now, on the triple net properties, it's going to be a zero for the contract term. But this formula is universal across all bands of commercial real estate.
Yeah.
So, David, what we're going to do today is really break down that question of, does it make sense to leverage or pay all cash? What about the money you've got to spend on the interest and the principal repayment? To do that, we're going to break down the cap rate, which is what folks hear about all the time as a metric for analyzing the return from commercial property, versus cash on cash. And so if we go to the next slide, we're going to start breaking it down.
Okay, so here we have the cap rate, which is the potential gross income minus the vacancy, gives you your effective gross we just talked about, minus your operating expenses, gives you your net operating income. So what we're doing here is to show cap rate, is we're taking that net operating income and dividing it over the purchase price. So this is before we get to debt service. And usually a simple way I explain cap rate to people is it's the return you would get if you bought in all cash.
Yeah, exactly. And one of the reasons why this is the standard is because it does not include the financing. And so when we start valuing commercial real estate, the cap rate is where the appraiser is going to begin, and the financing really has nothing to do with the value, the market value of the property.
Because different buyers will get different financing,
correct,
different terms, and they might finance it in different ways. So
right,
that way you're getting a little bit closer to apples.
Exactly.
Let's go through an example. Let's say you have $80,000 in NOI, net operating income, over $1 million purchase price. That would be an 8% cap rate. It's pretty simple.
Straightforward numbers. So now we take a look at cash on cash. We've got to take that NOI that we just looked at. We've got to subtract out the debt service, which will get us to the cash throw off. So here, the calculation for cash on cash is the cash throw off over the cash invested. Now, if you remember the cap rate, the NOI was over the purchase price, but here we're looking at the cash invested as the denominator in the fraction.
And so let's use another example. Let's say that on our previous example, this person's putting down 50%, which would be $500,000 over the $1 million purchase price. At a 7.5% interest rate, that gives you just under $42,000 in annual principal and interest. So let's throw that in here. And so we take our $80,000 in NOI, subtract out another $42,000, and we get about $38,000 in cash throw off. And so we're going to divide that over our down payment, which is your cash invested, and you get a cash on cash return of 7.6%, which is lower than our cap rate.
Right. So as an investor, you'd be looking at this from a couple scenarios. If you have the cash to pay all cash, and cash flow was your number one concern, then it would likely make sense to pay all cash. If you don't have all cash, you want to get involved in a property like this, you'd be willing to likely accept that 7.6 to take advantage of the financing so you could get into the investment. But we're going to go a little further as we break this down.
So if you pay all cash, there's no debt service, so the cap rate and cash on cash are the same.
But the leverage creates some opportunities depending on the terms of your financing. And the two key variables are straightforward mortgage interest rate and the percent down. If we play with those numbers, you get a low enough interest rate on the mortgage, you put more money down, less money down, it's going to impact not the cap rate remains unchanged, but the cash throw off and the cash on cash is where you're going to see significant movement.
Okay, so here we have an example chart with some different numbers. So here we've manipulated the percent down, but we've kept it at 50% for all of these examples. Then we have the interest rate, which is really what we're changing here to show you some different examples. And as the interest rate goes down, the cash on cash return increases, which makes sense because you're paying less money in interest, so that's more money that you're profiting on the property. And right around where the cap rate is at 8% is kind of where you'll see there's a difference, right? Now all of a sudden you can get a higher return if you have and it's not exactly the same, right? Because you're at a 7% mortgage rate, you got an 8% cap rate, and you have an 8% cash on cash return.
Right.
So, sometimes people will call this like inverted yield, where you're actually paying more on interest than you're getting on your cap rate, those types of things. And people tend to stay away from that because, there's a little bit of speculation if you start investing where you're actually paying more in interest than you're getting in a cap rate. So we could talk a little bit about that. I think, is there anything else you want to say on this?
No, I just wanted to do this for illustrative purposes on the percent down and the mortgage rate impacting the cash on cash.
Yeah. So I think that's good to kind of see some of these numbers. And really, we're not to the meat of why somebody would use leverage, because I think really the most important reason would be for appreciation. So if you pay all cash and the investment goes up $100,000, you've made 10%, right? 100 grand over $1 million, that's your 10% return. Now, if you put it down $500,000 and you get the same rate of appreciation, so you get $100,000 in appreciation, well, now that's on $500,000. So now that's a 20% return. So you've doubled your return by getting 50% leverage, or 2 to 1, right? So that, if you were to get 4 to 1, that's 25% down. So you could just take the 10% and multiply it by 4. Now you have 40% appreciation. So this is where people can get some really phenomenal returns in real estate, is through leverage and appreciation.
And as we now circle back to the initial question, talking about profit. Well, profit in any real estate investment comes from 3 forms. You have the cash flow, which was where the question's perspective was coming from. Then you're going to have appreciation, which is where most wealth is built from. And then, as you'll see in the final slide, you also have tax shelter. And when you're using leverage, you're also leveraging the return on your tax shelter. That's the icing on the cake. And essentially, as you can see, it's checkmate, game over if you've got a successful investment strategy that's leveraging all 3 sources of return.
Yeah, when it comes to the tax shelter, I mean, we have some clients this year that have said to us, hey, I'm gonna have a really big profit in my business. We work with a lot of entrepreneurs, and I need to shelter that. I don't really want to pay the government all that money, so they're going to use things like bonus depreciation and doing a cost segregation on the commercial property in order to shelter a big chunk of their taxes for the year, which is a really great strategy. And that's so far, the plan is it's going to get phased out. So they want to take advantage of it this year while there's still 80% bonus depreciation. So if you're interested in hearing more about that, if you have a large tax gain this year that you're expecting and you're like, wait, you're telling me I may not have to pay taxes, or I could at least reduce it substantially through totally legal methods, we could show you how to do that using bonus depreciation. So reach out to us, go into the description. You can schedule a call directly with Lee or I, and we can talk about what your goals are and how much tax that you need to shelter. I want to take a step back to leverage because I think, and appreciation, because I think that is such an important aspect. I gave a talk at a conference probably 13 years ago at this point, and the talk was, why my goal is to get $1 million in debt. And I think I'm just trying to break the paradigm that some people come growing up hearing like, oh, you have to pay all cash, debt's bad, and that just this difference between good debt and bad debt. And using debt in real estate in a way like this, where it's relatively low interest and potentially fixed for a term, and there's a lot of things you can do in commercial real estate to make sure you're setting yourself up for success. It's a little bit different than residential, where it's really easy to get a 30-year fixed rate mortgage. Right. Mm-hmm. So there's some caveats here between commercial and residential. But the thing is trying to accumulate a lot of good debt because it's a hedge against inflation, so that's one reason. But also this leverage point, if you really understand the financial engineering around real estate, and that's where I feel a lot of the money is made. There's the glamour of watching these fix and flip shows, and people really think that that's sexy, getting to make a house look really beautiful, and that's cool, and that is really fun, and we're doing some of that. But the financial engineering of working behind the scenes on the numbers and finding a deal that you can really tweak with the right form of leverage, and you have a pretty good idea of what you think the appreciation is going to be. Maybe there's some forced appreciation, right, which is a little bit different, where you're actually creating value in the property. Maybe it's we've done this through a subdivide. We've bought properties that were just basically looked over because somebody didn't realize the potential there. There's lots of different ways you can create forced appreciation, and with the correct financial engineering, really create some phenomenal returns for yourself. So I think that the appreciation and the leverage portion of it is really important to get to understand. And so I look at a lot of these things, even if you are paying 8% interest and you have a 7 cap, there is a real good argument why you can make on the right deals. And that's the important part. You got to be buying right, getting the right deals where those types of structures make a ton of sense. Mm-hmm. So if you're curious, reach out to us. We love talking about this stuff. Thank you again for asking the question on our channel. If you have any other questions, please go ahead and ask them in the comments. We love getting on there and answering them. We've done a pretty good job of answering most of the questions that have been asked. And if you got a lot out of this, share it with a friend, like it so more people can find it. And again, you can reach us, go down to the description, shoot us an email, shoot us a text, whatever is the best form for you. And we look forward to catching you on the next video.
Thanks, everybody.